Hello and welcome to Bloomberg Quint. We're in conversation with Ravneet Gill, CEO of Yes Bank. The bank reported a return to profits in the first quarter of the current financial year, but there are still asset quality concerns. We're hoping to get clarity on both the road ahead and also some of the persistent issues with Mr. Gill. Thank you so much for taking the time.
Pleasure.
Mr. Gill, before I get into the numbers, I'm sort of going to ask you a little bit of a big picture question. You don't need me to tell you that the street is still fairly worried about the asset quality picture. It seems like the entire industry has gone through this cycle. You're not an outlier. The PSU banks went through it, the private banks went through it, but they have seen their asset quality troubles peak and come off. But Yes Bank just seems to be starting on the cleanup. Is it late? Was it a different set of stress that Yes Bank is now dealing with, which others had dealt with earlier?
So I would say two things, Ira, to begin with. First and foremost, that it's not a starting of a process as far as we are concerned. This quarter represents the peaking of a BB and below book, and from here we just see it going in one direction, which is down. Okay, so we see actually a fairly material contraction in our BB and below book in the upcoming quarters. When you say that the other banks went through situations like these, I think the distinction that you need to make is that for many of them it was a cyclical issue. And the resolution cannot happen till the time that the cycle reverses. For us, I don't think that's really the issue. If you look at our BB and below book, it's not as if it's a very granular book or which is very heavily exposed to a particular sector or a particular industry. This is a handful of concentrated exposures which are facing liquidity issues, not solvency issues. And so the reversal of this could also happen very quickly. So we feel that each of the resolutions, when they happen, and I expect at least two of the larger resolutions to happen this quarter, you will see a fairly big contraction in our BB and below book.
So the problem you're saying is not that you focused on certain sectors like infrastructure, which other banks did, but then maybe the mistake was on certain groups. And I think we do know that there are at least a couple of large groups in your portfolio which at a group level, promoter level, are facing stress. How easy will that be to resolve?
So I think, it's in hindsight, you can always say it was a mistake or, it was poor judgment. But if you see when these exposures were assumed and the ratings of these counterparties, I mean, they were absolutely fine. I mean, they were all investment grade and in good health. I think what happened was that post-September and what happened with ILFS and then to the NBFC sector, we've seen tightening of credit markets. Refinancing has become tougher. And I think some of these groups have taken the brunt of that. It just so happens that the timing was such that each of them, faced this issue with regard to liquidity at the same time. And to that extent, you can start checking in terms of, what the underwriting rationale behind this was. I don't quite see it that way. Like I said, it's really a timing issue. But equally, if you see that the underlying assets that these companies have, those are very, very good. And the resolution here does not need to happen in terms of reversal of fortunes of the company per se, which could be a medium long-term event. Here the resolution could happen on the back of asset monetization, it could happen on the basis of a stake sale, it could happen in terms of a change of control or ownership. And I think that's what's effectively happening in many of these names. And so to that extent, I don't think this recovery process should be so protracted.
Okay, so the focus now is on the BB and below book, which is about 9% right now?
That's right.
Okay, and you would see it come down to what, over what period of time?
Significantly, because if you see the composition of the BB and below book, it actually has very few names. And so each of the names which comes out of it on the back of resolution will actually bring it down significantly. So over the next few quarters, I actually see this book contract very, very significantly.
Okay, but the stress didn't only come from the BB and below, right? I think a couple of these names that we're talking about, these two financial services, would have been in the A category. No, and the A rated is at 41% of your book.
No, so I think, let me just draw that distinction for you. As far as the growth in the BB and below book from 23 to 29,000 crores comes effectively on the back of two names. And these are two large financial services companies. Here we don't have loans, we have bonds or NCDs. So these in any case get a mark to market. So even if you go back to the last quarter and you look at a treasury line, you will see the mark to market on that. So it's not as if these were names which were not known or which have suddenly cropped up. It's just that the level of the mark to market has gone up based on the rating downgrades that these names may have potentially suffered. But the entire slippage for the quarter, if you see, comes from the BB and below book. Okay. Now the question is that not all of it comes from the watch list that we put out. The reason for putting out a watch list in the last quarter was very, very clear. We were going to be approaching investors for equity, And we looked at names where there were imminent repayments, where we thought that the cash flows could not support those, and we thought it was only right, it was prudent to be able to go out there transparently tell investors that these names could slip. Now, the fact is that the subsequent slippages that may have happened did not only happen from the watch list, but happened from the BB and below book, and at the end of the day, the watch list was derived from the BB and below book. So I thought we've got that ring fenced in terms of which were the names where we could potentially face stress. And as far as these two financial services names are concerned, yes, I mean the mark to market on those has gone up based on the rating downgrades.
Okay. No, so sorry, correct me if I'm wrong here. So these two names would not have been BB and below last quarter, right? In the March quarter, they weren't.
They weren't.
They were not.
They were not, but they had. Yeah. But even though they were investment grade, they had already taken some rating downgrades, and the mark to market for these names was reflecting in our treasury income even last year, even last quarter.
Okay. No, the reason I'm asking that is that one is wondering that from even the A pool, which is very large, which is about 40% of the book, is there an assessment being made by the management that what from that pool has the potential to fall either below investment grade and potentially to a slippage point?
So when we talk about the asset portfolio of Yes Bank, I think one of the things that comes up is the real estate book that we have, which is roughly about 24,000 crores. If you look at the 24,000 crores, 25% of that is fully captured either in the BB and below book or in terms of the NPAs that we have. On the balance 75%, the slippages are absolutely minimal. When I say minimal, they're very small. And then if I look at my overall investment grade corporate book, my SMA2 on the entire thing is about 404 crores. So given how large the asset book is for Yes Bank, and then you look at a number of 404 crores, I think it's really a very, very small marginal number.
And SMA1?
And I think it gives you, SMA1 is more dynamic, so it's more harder to tell, but SMA2, which could potentially point towards potential slippages or incipient weakness, that part is fully captured.
Okay, so just on these two names again, and this is at the group level. One is pure financial services. I know everyone knows what these is. The second is group level exposure, which is very large at a group level, right? I mean, I think in terms of CET1, it would be what, close to 40-50% of CET1?
No, so I think difficult to speak publicly about client information, but we don't deny that it's a large exposure, but equally it's a very well collateralized exposure. So we don't really feel that concerned with regard to the size per se.
Okay, and can you give us a bit of granularity on the kind of collateral that is backing some of these loans? I don't mean specifics, but is it equity? Is it large assets which are functional? Just trying to understand the recoverability.
Mainly large functional revenue generating assets.
Okay. And the resolution for these would happen at an industry level?
No, so these are bilateral, lendings, and the collateral is charged to us. So this is really a bilateral, process between us and the borrower in terms of the resolution as well.
Okay, so you would expect it to fructify in 2 quarters?
So okay, I mean, I think if you look at that one particular borrower that you're talking about, I mean, some of those assets which are collateralized to us are large. So the timeline on that could be longer, but for 2 of the other large exposures that we have, I expect the resolution to happen this quarter.
Okay, just a quick word. So you are adjusting them also in the context of the RBI's large exposure framework, the exposure to some of these groups? So
only one of them, is relevant from a LEF perspective.
Okay, just on the provisioning side, sir. So I think the provisioning this quarter you used some of your contingent provisions. You didn't do a huge amount of additional provisions this quarter, but the coverage ratio is then relatively low, right? Still at 43%.
So the what we used out of the contingency provisioning was for assets that has slipped from that book. And whatever
from the watch list,
and whatever were the business as usual slippages, we provided for that incrementally. We have always stated that the medium-term plan for us is to get to a PCR of about 60%. But what we were very conscious of is that last quarter our PCR was 43%. We will not go below that, and we've held our PCR at that level.
Okay. So there are some concerns about the sort of stress which is unprovisioned for, where, for instance, I'm putting to the view that Credit Suisse put out, which is the net NPA number plus what is on the watch list plus what is BB and below. So if you take all of that unprovisioned exposure, it is relatively large.
No. So Ira, do remember one thing, that the watch list was drawn from the BB and below book. So it's wrong to see the watch list plus the BB and below book, right? It's not that.
Okay.
The watch list has actually been drawn from the BB and below book.
Okay, it's a subset of that.
It's a subset of that. And the reason, like I said, we put out that watch list was to be able to, transparently on a proactive basis show investors that we thought there could be slippages. Now, point is that on our part, that was a move that we'll move to more prudent accounting, become even more transparent, tell people ahead of time that where we were seeing potential weaknesses. But what has happened, effectively speaking, is in the minds of many, the watch list seems to be independent of the BB and below book, which is not the case. Okay. It has been derived from the BB and below book, and the entire slippage that happened for this quarter has actually come from the BB and below book itself. Okay,
so what percentage of BB and below is already in a watch list, roughly?
So last quarter, our BB and below book was 23,000 crores.
Now it's 29.
It's 29, and it's just the balance 6,000 crores has only come from these two financial services names.
Sure.
But the watch list of 10,000 crores was 10,000 odd crores. So I would say that roughly about 50% of the BB and below was the watch list.
Okay, and you're fairly confident, having, I'm assuming, sort of scanned all aspects of the book, that the watch list would not increase further unless there's a large sort of stress to some industry from an economy perspective.
Yeah, I mean
10,000 is last quarter was 10,000. It's still at 10,000, even though 2,500 has slipped into NPA.
So one of the, I was going through some of the commentary, and they said that why were the two financial services names not part of the watch list last time? There's a very simple reason for that. The watch list was drawn out, and contingency provisioning made against that. The two financial service names were not loans; those were investments. So we could not have taken a provision against those in the traditional sense of the word. But the mark to market on those was reflecting even in the last quarter, and that mark to market is driven purely rating driven. So there's no subjectivity in terms of the decision that the bank makes in terms of the quantum of provisioning or whether or not to provision. So that was already being captured in our treasury line in terms of the mark to market, so there was no need to put it into the watch list as well.
Okay, because that would have been double accounted.
That's right.
Okay, and that's the reason why this is not being reflected in the credit cost, because I think that was the other commentary that was coming out. Why is this not flowing through the credit cost?
It was always there. So when we talked about a credit cost of 125 basis points, the mark to market was always away from that, because that moves up and down dynamically based on the ratings.
Okay, just a couple more questions on this, and then we'll move forward. So how much uncertainty do you foresee in your capital raising effort from asset quality concerns? You've been speaking to a bunch of people, I'm sure you've been out there. Are they reasonably confident that you've seen what is there to be seen and decided how to deal with it?
Absolutely, and we can keep talking about the asset quality, but what investors have also seen is that at the end of the day, these are a handful of really concentrated exposures. The upside to that is that each resolution materially improves your upside.
Yeah, good.
Yeah, so I think investors see that equally, and in some of these cases now the resolution seems to be completely imminent. So I don't think that there are any fundamental concerns, so to speak, with respect to investors. I think they've seen our book, they see exactly the quality of the portfolio, what the investment grade book looks like, and if one of the resolutions was to come through, that would be great, because that would have shown the direction of travel. But they realize what the complexion and the granularity of the book is.
I think the problem perhaps is that resolutions at a system level have just not been as seamless.
Which is a fact, but neither of these is actually a systemic resolution. So none of these are going into like you would see
NCLT
there. I mean, here it is more. In some cases there may be a larger group of lenders, but it's between the lenders and the borrower. It's not as if that there are other agencies involved which then prescribe a certain resolution format.
Sorry, one backward-looking question, and I know this predates you, but still, what is the vintage of this chunky exposure that is built up? Has it happened over the last 3 years or 2 years when we saw, yes, sort of, continuing to grow very fast, even though, the environment was throwing up some red flags, or has it just been there pretty much since the beginning?
I think it's the relationships were initiated over a period of time and then, steadily built up, but it wasn't as if we saw a certain spurt or anything. I think these are legacy exposures that have been on the books for quite some time, and I think over a period of time were built up.
Okay. Capital raise. How soon? I know you said Q2 event, but I think it's becoming a little problematic. CET1 at 8% is...
So nobody obviously is more mindful of the CET1 than we are.
I'm sure.
And clearly, we realize that there's a big market opportunity out there. The competitive landscape is reasonably benign. And we also know that how we could go full throttle on the back of growth capital. So I think I made the point yesterday on the analyst call that why we are raising capital is not really with respect to building up buffers or cushions to be able to take incremental provisioning, etc. I think our PPOP can look after that. What we are really solving for is growth, and we are really wanting to grow. So clearly, you know, the in terms of capital raise sooner than later. But you know, as I mentioned, that I remain confident that this is a Q2 event.
Large dilution though involved in that capital raise, especially at this price?
At this price, yes. I mean, look, if you want to raise large capital at this valuation, then obviously, you know, that means a larger dilution. But I think all the stakeholders of the bank are very clear that, you know, they will do whatever is in the best interest of the bank.
Okay. It would have to be private equity at this stage? I'm not sure the QIP market would be...
No, I think we have enough and more interest from both private equity and from public market players. And so it could be either or it could be a combination of the two.
In more than one tranche, potentially?
Could be more than one tranche, but could be one tranche as well.
Okay. Given that, you know, if one assumes that you get this capital, say, in some point in Q2, the full year growth would be what, 5-7%?
No, I think
could be lower.
No, I think do bear in mind that for the first quarter, we were in a capital conservation mode, and when you are looking at capital optimization, then you're churning your book a lot. So as you see, our wholesale book actually degrew, although the retail was up. Yes. I think, you know, if we could raise capital in this quarter, which I feel totally confident about, we could definitely still go into the high teens for this year.
Oh, really? You think that's doable?
Absolutely. I think the market opportunity is there to be taken.
On the back of retail or other segments?
I think I'm talking about the overall franchise. So there is absolutely no effort on our part to de-emphasize the corporate business at all.
Sure.
That remains the calling card as far as Yes Bank is concerned. It's just that we are trying to build a more balanced, more holistic book, and so retail gets its place in the sun too. But I see opportunities across both retail and wholesale. On the wholesale side, you see that, you know, a lot of the players have been taken out of the market, you know, because of the dislocation that the market is facing. And then on the back of that, you're also seeing that lots of retail portfolios are available for sale. So the ability to be able to go there and grow inorganically on the back of capital, I think, is also significant.
And incrementally, what would be the rating profile of borrowers that you'd be comfortable with? You know, X% up, A and above.
We won't want to tie ourselves up in knots with regard to having very tight such parameters. But clearly, I mean, we'll be very discerning in terms of the sectors that we expose ourselves to, and the vectors of the economy that we want to really build upon.
Okay. You've stressed significantly on the liability side and the need to build that out. This quarter, though, CASA ratio and in absolute terms you saw fall, right?
So I think it's very important to see the fine print on this one. So while our CASA did come down, if you see our term deposits, especially retail term deposits, went up. So if it came down, I don't think it represented a lack of confidence in the bank. Otherwise, our term deposits wouldn't have grown. And I'm talking about the retail term deposits. So a lot of our SA converted into term deposits, which shows that investors and depositors have long-term, confidence as far as the bank is concerned. But given the fact that we were in a capital optimization mode and we did, rationalize our credit, corporate lending, some of the corporate CAR that sits with the bank moved on, and which is always tied to the level of credit that you're willing to provide to many of these corporates.
Okay.
So I think if you look at it from the retail liability standpoint, it remains a very robust franchise.
But how has your strategy on the retail liability side changed in terms of rates? Because you would also want to bring down your cost of funds eventually.
So, at some point in time when we were growing very quickly on the asset side, we were a little more generous in terms of the rates that we were able to offer. I think the medium to long-term solution to this really is a structural change in terms of just bringing down our cost of funding. And bringing down that cost of funding would mean having a very robust, sustainable liability strategy. One of the key pillars of our liability strategy is really, of our retail strategy is really the liabilities business. But you can't have a liability strategy on a standalone basis. You need to have the retail asset cross-sell too. So that is where it will provide the buffer to our liability strategy. But we are now making our liability strategy very granular. It's gone down to every single one of our 1,100 branches is being looked at, the market opportunity being dimensioned, the client segment being dimensioned, product proposition being dimensioned, pricing and analytics going into it. So many of our branches now we have actually designated as CAR branches simply because those catchment areas are very rich in current accounts. So it's a very granular strategy. It will be absolutely bottom up, driven bottom up, and I think it is already beginning to reflect in terms of the complexion of our liability profile.
Okay. Correct me if I'm wrong on this, but I remember in one of your initial presentations, you talked about that a significant proportion of the retail branches were not profitable, and that you needed to turn that around. You needed to focus on profitability at a branch level as well.
So I think was taken a little bit out of context.
Okay, sorry.
So out of the 1100 branches that we have, 400 are rural branches, which is the social banking and the inclusive banking part that is there, and which are that much tougher to break even and make profitable, given the fact that you need a much stronger cross sell over there. The second part of it is that branches take time, so it's also a question of vintage. It's still a very young bank. So when that comment that was made was also keeping in context the 400 rural branches, as well as the fact that many of the branches are very young. Branches take a couple of years to be able to break even. I think that's absolutely on track, and our estimation is that by 2025 every single branch will be profitable.
Okay. Last point of conversation is on the governance aspect. We've seen a significant churn at the board. I know board members have cited personal reasons, but I think we've all come to be a little skeptical of large-scale resignations with personal reasons. What's going on at the board level, sir?
No, I think there were two resignations, both of them regretted resignations. In one case, the individual wanted to go back and pursue his interests with respect to academics. He had actually expressed the desire to the board a lot earlier, but given there was a management transition in the way, he was asked to stay back, which he did. The other board member who resigned wanted to pursue other interests which he could not have done as a director of a bank. So that's why he stepped out. So yeah, the timing may look a little strange, but I don't think we should be reading between the lines on that at all. The board is completely stable, completely aligned. No issues with respect to that.
And what is the role that the RBI appointee on the board is playing? I think that sort of sparked a little bit of concern as well, because it's a rare move.
So it's a rare move. I agree with that, and the provision that govern the appointment of an additional director by Reserve Bank of India on the board of a bank is just one provision. So, and it covers everything, and to that extent, I think the market misread a little bit that what was RBI trying to achieve. I think the coming of Mr. Gandhi, given the fact that he was a deputy governor of DBR and very familiar with regulations, was really to be able to provide that expertise, the depth. Add to the management solidity and the functioning of the board, and which is exactly what he's doing. I mean, we find his inputs to be very constructive and very, very knowledgeable, of course.
Is there any any guidance, for the want of a better word, on how long an RBI nominee would need to be on the board, or is that completely up to the regulator, I guess? So
the appointment is made for 2 years, or earlier if the RBI so decides.
Okay.
So I would say that yes, it is at the discretion of Reserve Bank of India. And they will take the call in terms of the overall tenure of the director.
At the management level, how much change are you making within the bank? Honestly, it would be completely understandable if a change had to be made, because the bank has seen troubles emerge, and one would assume that those people who were on those functions would need to pay the price, for the want of a better word.
So I think if you look at the overall quality of management of Yes Bank, I think it's absolutely top class. So you don't want to just change somebody because he happens to be, a carrier of the legacy. I think where we, right up front, I articulated that what we would want to strengthen significantly are the control and the, the regulatory functions, etc. So we've brought in very, very senior people. We have a new head of compliance and governance. We have a new head of financial management and strategy. We are in the process of hiring a chief operating officer. I've mentioned that publicly. In the businesses, what we've done really is that we've looked for gaps where either the domain expertise or the skill gap has existed, and hired people selectively in a very focused fashion. So we have a new head of real estate, for instance, who has long-standing industry experience to come and lead that business, given that that's a large business for the bank. And wherever we think that there is a need to strengthen a function or to be able to enhance the skill, we'll continue to hire.
So you don't foresee sort of significant management churn from here on? Whatever had to be done has been done?
No. Like I said, that we will continue to hire wherever we think. So, if, for instance, if we want to get into a new client segment, or we want to get into a new industry, or we want to get into a new product niche, if that means having to bring talent to be able to make sure that we are able to do that in a sensible, profitable fashion, we will do that. So I think as it happens in most organizations, it should be a more dynamic process. And as you go along, you keep strengthening management.
Any qualitative changes on the risk management side that you have made? How it's structured, how it's done?
So I would say that have we made changes? Yes, we have made changes. So the delegation between the board credit committee and the management credit committee, we've changed the metrics on that. We in terms of our structured finance business, which was earlier largely asset backed, we definitely want to make that a lot more cash flow backed. There are certain sectors of the economy which have faced headwinds. We certainly want to reduce our exposures going forward, or in any case grow there in a very calibrated fashion. I would say that these are the primary levers that one has put into place. But other than that, of course, it's really business as usual.
Structured lending in particular, because I know that there is pain that has come from there.
So pain has come from there, and also equally a lot of profitability has come from there. I think it's one of the businesses which was a USP as far as the bank is concerned. I don't think you have too many banks in the country who today have the ability to be able to make large underwritings over a long period of time. And the bank did that in a very successful fashion. I think some of the underlyings of that business need to change. Like I said, one could be that instead of making it asset backed, make it more cash flow backed. But it's a business which still has a lot of legs in this country. It still has a lot of headroom to grow, and it's not a business that we want to walk away from.
Last question on the presumption that maybe we'll be able to speak to you a year later. What will the bank look like once you're done with this sort of clean up, for the want of a better word, phase? The growth, the focus. What will it look like to you?
So first and foremost, why the presumption that you'll get to speak to me 1 year later?
I'm hoping I'll get time with you.
No, we should definitely speak before that. I think, as I mentioned, that the bank has been very strongly asset-led in the past. If there's one structural change that I would like to make, is to be able to bring down our cost of funding. And to be able to bring down our cost of funding, we need to become a lot more liability focused and a lot more liability driven. And a lot of articulation of mine in terms of growing the transaction banking business, growing the retail business, is really to be able to drive our liability initiative. So that is one fundamental structural change. The fallout of that will be stronger, broader NIMs, and of course the fact that your earnings profile will start to look a lot more balanced than it does currently. And I think if I look at the market opportunity as far as India is concerned, I think it plays also to that. At the end of the day, I really think that you should map your footprint to what the real market opportunity is. And if that means over a period of time you're changing your focus, then so be it. I mean, I think that's what enlightened organizations do. The one point that we didn't touch upon, but which I think is very fundamental and which will be a big thing against which I'd like to hold myself accountable, is the whole digital piece. I still feel that whether it's the analyst community, whether it's the investor community, whether it's the press, are underestimating the change that will come in financial services on the back of technology. One of my favorite things is, and it's not an original, I picked it up from somebody, is that banks will become technology companies with a banking license. And I think it would be worth the while of the market to be able to understand and comprehend that in that space, the very unique strengths that Yes Bank has. And as the landscape changes on the back of digitalization, I think there is hardly another player in the market which has the ability to harvest and harness that change, either in terms of size or in terms of speed that Yes Bank has. And it's something that we are not taking for granted. We continue to invest in that. We continue to make sure that we have very good resources attached to that. And all the statistics seem to suggest that we are reinforcing our digital leadership in this space. And I think it will have a profound influence on both our liability and our asset business.
All right, Mr. Gill, I'll leave it there. Thank you so much for your time. Thank you for taking all of our questions.
Thank you very much.
Thanks for watching Bloomberg Quint.